Hello and welcome to another tutorial video. This time around, we're going to go through the same type of setup we usually have and answer a really good question that came in to our help desk and support system the other day. So here's the question that came in. It relates to enterprise value, equity value, and cash, as you can see right here. If a CEO of a company picks up $100 of cash on the ground and puts it in the company's bank account, what happens to the company's enterprise value? So that's the question. And in this case, the student had received this question repeatedly, or variants of this question, in investment banking interviews. He wrote into us and asked for an explanation of the answer because he didn't understand it whenever interviewers went through it with him and actually answered it for him on the spot. So what this question is really getting at is, if a company gets $100 of extra cash, does enterprise value increase, does it decrease, or does it stay the same? The answer is that enterprise value stays the same. So I hope you got that right, but if you didn't get it right or you don't quite understand why that happens, we're going to go through it in this video, and I'm going to give you two different ways to think about how to answer this question. One of them is a little bit more abstract, and it's based more on finance theory. The other method is more of a real-world analogy and something that you might think about when you're going to buy a home or a car or something else in real life. So whenever I answer this question, and in this case, when I actually did answer this question and I gave the student this answer, I get a very common follow-up question, and the student here asked the same follow-up question, which is, wait a minute, you subtract cash in the enterprise value calculation. So if you subtract cash, in other words, if cash reduces enterprise value, how can enterprise value possibly stay the same when a company gets a certain amount of extra cash? It is true that in the formula for enterprise value, you do subtract cash. The formula is usually written as equity value plus debt minus cash plus non-controlling interests plus preferred stock, unfunded pensions, other items, and then you subtract investments and various other non-core assets. So if you just look at this formula and you take it at face value, you'd probably answer the question the same way he did, which is that obviously if cash goes up and you're subtracting it, then enterprise value has to go down. How could it possibly stay the same? So as I said, there are really two ways to think about this issue, and I'm going to go through the first one right now. The way that I would think about this is not to think about the formula, but to think about what enterprise value actually means. So what we just went through is how you calculate enterprise value. You take various numbers, you take the company's market cap or equity value, and then you add or subtract items. And that is how you calculate it, but there's a difference between calculation and meaning. And we want to focus on what it means here. Enterprise value represents the company's core business operations, the value of those core business operations to all the investors in the company. So you're looking at not side projects or side activities or other random lines of business the company is in, but only its core business operations, and you're looking at what those are worth to all the investors, equity, debt, preferred, possibly other investors. Whereas equity value represents the value of everything the company has, but only to the equity investors in the company. So you're not looking at debt investors or preferred stock investors, and you're also not subtracting out these side activities, anything that's not core to the company's business. So those are the relevant definitions. And the implications are that when you calculate enterprise value and you start with equity value, you have to add items when they represent other investors, and you have to subtract items when they're not related to the company's core business operations. So items like cash or excess cash, investments, real estate, anything that's not really what the company does for its main business. So let's go back to that $100 in cash now. The question you should ask yourself is this item part of the company's core business? Is it what the company does on a daily basis to sell products to customers? And the answer, of course, is no. Getting $100 in cash has nothing to do with the company's core business. It doesn't make the company more valuable as a result of getting this. It's not going to improve their products. It's not going to increase their revenue or increase their EBITDA or anything like that. So it is not part of the company's core business. It is part of everything the company has. So if you look at a number like equity value, then yes, this $100 of extra cash is going to push that up because it is part of the general collection of assets that the company has that make it valuable in the first place. So in this case, what ends up happening is that equity value increases, but cash also increases, and so the enterprise value stays the same. If you remember in one of the previous tutorials, we looked at something like this and saw how equity value and enterprise value change when a company issues shares, or when it raises debt, or when it repurchases shares or repays debt. And what's really going on here is something similar to this first scenario, where the company issues a certain amount of shares. Because just like in that first scenario, the company's equity value is going to increase. Its cash balance is also going to increase. Since you subtract cash, the enterprise value stays the same. And so the enterprise value based multiples are also going to stay the same. So that is one explanation for this. Now, the question you might have is related to equity value at this stage, because you might look at this Excel file and say, okay, well, it makes sense how equity value would increase if the company issues more shares, because they have more shares. That means that they have more equity outstanding. So it makes sense intuitively why it would increase. But why does equity value increase when the company's cash balance increases? I would think about this one with the following logic. Equity value should implicitly reflect the company's cash balance already. What I mean by this is, if a company has $500 in cash, could its shares possibly be worth less than $500? If you sit back and think about it, it doesn't really make any sense. Its shares, the value of its shares, its equity value should be worth at least $500. Because if that's not true, then you can buy one of their shares and effectively get free money, because the company has more in cash than its equity value is worth. So it doesn't really make any sense. It does happen sometimes in real life, though not very often these days. But the bottom line is that its equity value should always be worth at least what its cash on hand is worth. And usually, of course, it's worth a lot more than that. So that's how you can think about it. And of course, the other method is to think about the fact that equity value represents everything the company has, all of its assets, anything at all that could be worth something, regardless of whether it's related to its business or not, but just to the equity investors. And so from that perspective, that cash they get is worth something. It's not really their core business, but it is worth something. And that's why the equity value is going to go up when they get this cash, when the CEO picks it up on the floor. So that's one way to think about it, using some of these definitions and some of our previous tutorials on what happens when equity value and enterprise value change when the company issues shares, debt, and so on and so forth. But there's another way that you can think about this using more of a real-world analogy. Whenever you see references to enterprise value, people often explain it by talking about buying a house and how enterprise value represents the total value of the house. And specifically, if you buy a house, regardless of the mortgage and the down payment you use, enterprise value is sort of like the total value of the house. So if you buy a house for $500,000 with a 50% mortgage and 50% down payment split, you have $250,000 of mortgage and $250,000 of equity, and the house's total value is still $500,000. Now, if you have an 80% mortgage and a 20% down payment, now you have a $400,000 mortgage and $100,000 of equity, but the house's value is still $500,000. And then finally, if you have no mortgage and a 100% down payment, you have no mortgage, you have equity of $500,000, but the house is still worth $500,000. So this is a common analogy that is used to explain this concept. And I'm going to give you an extension of this analogy to explain this particular question. What if, when you're going to buy a house, you and the existing owner of the house find an extra room? So maybe you measure the house and you figure out that it has more space than you originally thought, or there's some kind of hidden extra room underground or something of that nature. What would happen to the home's price if you find that extra room somewhere? And the answer is that, of course, the home's price is going to go up. Its total value is going to go up because the house is now worth more intrinsically. It has more space, it has more square feet or more square meters, and so it's worth more, and buyers should be willing to pay more for it. And this is sort of like what happens when a company's enterprise value increases. Something about its core value proposition to potential buyers goes up, its core business is worth more, and so its enterprise value increases. But here's the scenario we're talking about here. We're not talking about finding extra room. When a CEO finds $100 lying on the ground and puts it in the bank account, it's sort of like when you go to buy a house and you find some extra supplies or gardening tools somewhere on the property, maybe in the forest behind the house, maybe in a shed or the basement or something like that, and you find them, but you're going to go and sell them anyway. What happens in this scenario to the total value of the house? Well, the answer, going back to the logic we just learned, is that these tools and supplies are not core to the home's value. No one goes to buy a house so they can get extra gardening supplies or extra tools or anything like that. And so if the owner finds out about it, yes, he may charge you more upfront because he's saying, oh, I forgot about those tools, but you know what? You can have them. Just pay a little bit extra for this house. So he may charge you something extra, but you're going to sell those tools and supplies anyway. You're going to get the cash back. And so to you, the effective price of this house has not changed because this is not a core part of what you're actually buying. It's something that you pay a little bit extra for and you get it back and then you sell it and it works out to be basically no difference anyway. And that's what this scenario is like. The home's enterprise value stays the same when you have some kind of tangential or side activity related item like that you get that you're not going to use. You're not buying the house for that anyway. So the enterprise value in this case would stay the same. And it's really just like what happens when that CEO picks up $100 of cash on the ground and puts it in the company's bank account. It's not core to the company's business, and so the company's value, its enterprise value, stays the same. So the moral of the story with these types of questions, and I'm mentioning this here because they're so common in interviews, you'll often get these questions that are phrased as, what happens to enterprise value when X or Y or Z changes? To answer this type of question, I would urge you to not think about the formula for enterprise value because that can really lead you astray unless you really know this concept well and you understand exactly what you're talking about. What I would recommend instead is to think about whether or not whatever change they give you is related to the company's core business operations. And I think that's a much easier way to think about it and a much easier way to answer these questions. One test you can do to check this is to think about whether or not this change could potentially affect the company's revenue or EBITDA. So picking up something like cash is clearly not going to affect revenue or EBITDA. At best, all it's going to do is increase the company's interest income. Maybe it'll increase their dividend income or something like that, but neither one of these metrics will be affected. Something like raising debt or preferred stock, it's going to affect the company's interest expense or dividend payments, but it's not going to affect these core business metrics. And that's the best way you can decide what happens here. If the core business value changes, then enterprise value will change in some way. If the core business value does not change, then enterprise value will stay the same. So a few other examples of this would be cash, debt, preferred stock, the company's share count, a lot of what we went over in that previous tutorial, issuing shares, raising debt, repurchasing shares, repaying debt, getting extra cash, anything like that that is more related to the company's capital structure and the cash, debt, preferred stock, the number of shares they have, none of these are going to impact enterprise value. Now, one footnote here is that it's not quite true in real life because the cost of debt, cost of equity, and WACC could potentially be affected by all these. But for this style of questions, effectively, enterprise value is not going to change because the company's core business value does not change. And that is really the key takeaway from this lesson.